Picture this. It's December 2025, and you're scrolling through your investment app looking for income. The S&P 500 is paying a measly 1.15% dividend yield. Then you see VNQ, the Vanguard Real Estate ETF, flashing a juicy 3.98% yield. That's almost 3.5 times more income. Your brain does the quick math. $10,000 in VNQ gives you $398 annually versus just $115 from stocks. Seems like a no-brainer, right? Well, today I'm going to show you why that 4% yield is one of the most deceptive numbers in investing, and why the financial industry loves selling REITs to investors who don't ask the right questions. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Let's start with what VNQ actually is. The Vanguard Real Estate ETF manages between $34 and $36 billion in assets, holding 158 different REIT positions across the United States. With an expense ratio of just 0.13%, it's one of the cheapest ways to get diversified real estate exposure. But here's where it gets interesting. When most people think real estate investment, they picture apartment buildings, shopping malls, and office towers. Look at VNQ's actual holdings, and you'll see something completely different. The top holding is Welltower, a healthcare REIT at 6.55%. Number 3 is Prologis, an industrial warehouse REIT at 5.97%. American Tower, a cell phone tower company, holds 5.06%. Equinix and Digital Realty, both data center REITs, combine for 7.57% of the fund. This is a bet on e-commerce warehouses, hospital facilities, cell towers, and the infrastructure powering artificial intelligence. Traditional office space barely makes the top 10. Now let's talk performance, because this is where the story gets uncomfortable. VNQ is currently trading around $89 to $91 per share. Sounds fine until you realize it was at $96 in December 2024. That's a loss of 5.8 to 7% over the past year, while the broad market was hitting record highs. Over 2 years, VNQ has returned just 6.34% total, meaning it's basically gone nowhere despite paying dividends the entire time. The 52-week range tells the real story. A low of $79 and a high of $98. That's a $19 swing, representing almost 25% volatility. The annual volatility number is 17.72%, compared to the S&P 500's 12%. You're accepting 50% more volatility for that extra dividend income. And here's the kicker. Since VNQ launched in September 2004, it's delivered just 4.62% annualized returns over 20 years. The S&P 500 averaged roughly 10% annually over the same period. You gave up half your potential wealth. For what exactly? But wait, it gets worse. Let me introduce you to the villain of our story, the tax code. See, when you receive dividends from regular stocks, they're usually qualified dividends, taxed at 15 to 20% capital gains rates. REIT dividends are different. They're taxed as ordinary income at your full marginal tax rate, the same rate you pay on your salary. Let me show you the math that financial advisors conveniently forget to mention. If you're in the 37% federal tax bracket, that 3.98% VNQ yield gets destroyed by taxes. Even with a Section 199A qualified business income deduction, which lets you exclude 20% of REIT dividends from taxation, you're still paying tax on the remaining 80% at your full rate. Your after-tax yield drops to just 1.99%. Compare that to the S&P 500's 1.15% yield, taxed at 15% capital gains rates, giving you 0.98% after tax. Yes, VNQ still wins, but your 3.5 times advantage just became a 2 times advantage, and you're still accepting 50% more volatility for that privilege. Let's go deeper into the tax brackets, because this matters enormously. If you're in the 24% bracket, your after-tax VNQ yield is 3.03% without the deduction, or 2.4% with it. That's still decent compared to 1% from stocks. but climb into the 32% bracket and your yield drops to 2.71% or 2.15%. Hit 35% and you're down to 2.59 or 2.07%. The higher your income, the worse this investment becomes. And here's the scary part. The Section 199A deduction that provides relief was originally set to expire at the end of 2025. It's been extended through 2026, but nobody knows what happens after that. If that deduction disappears, REIT dividends become a complete tax disaster for anyone above the 24% bracket. Now let me reveal the puppet master controlling everything: interest rates. Here's the dirty secret the REIT industry doesn't want you to know. REITs don't make money from rent growth or property appreciation. They make money from interest rates falling. REITs typically finance 40 to 60% of their property purchases with debt. When interest rates rise, their borrowing costs increase and equity returns shrink. When rates fall, borrowing gets cheaper and property values rise. The research is devastating. REITs return an average of plus 3.2% monthly when the 10-year Treasury yield declines, but lose an average of minus 1.5% monthly when rates increase. You're not investing in real estate fundamentals. You're making a leveraged bet on Federal Reserve policy. In December 2025, the 10-year Treasury sits between 3.5 and 4%. Mortgage rates are stuck at 6.5 to 7.5%. For REITs to deliver strong total returns, you need rates to fall below 3.5%. When does that typically happen? During recessions and economic weakness. So you're essentially betting that the economy deteriorates enough for the Fed to cut rates aggressively, but not so much that it crushes real estate demand. That's a very narrow path to success. But even this understates the problem, because not all REITs are created equal. VNQ's broad diversification masks a civil war happening inside the real estate sector. Self-storage REITs have delivered 16.7% annualized returns over 30 years. Industrial REITs returned 13.3% annually. Healthcare REITs delivered 12%. These sectors crushed the S&P 500's 8.5% long-term average. But office REITs? Just 10.5%, underperforming the market. And office real estate is facing an apocalypse. Occupancy rates collapsed from 90.8% in Q4 2019 to between 81 and 86% today. Office REIT dividends plummeted from $2.9 billion in 2024 to an expected $2.3 billion in 2025, a 21% year-over-year massacre. 24 REITs announced dividend cuts in 2024 alone, with more cuts expected in 2025. Meanwhile, data center REITs returned 25.2% in 2024, trading at premium valuations of 27.6 times funds from operations. The problem with owning VNQ? You're forced to hold the office sector losers, alongside the data center and industrial winners. You can't escape the dead weight. The 2025 outlook makes this even clearer. Analysts expect overall REIT dividend growth of just 4 to 5.5%, well below the historical 7.54% average. Industrial REITs should see 14.4% dividend growth, the strongest category. Healthcare and data centers remain solid due to aging demographics and AI infrastructure demand. But office REITs face another 21% dividend decline. Total returns for the sector are projected at 8 to 10%, assuming modest valuation expansion and that rates cooperate. The consensus is clear. Meaningful REIT appreciation requires the 10-year Treasury to fall below 3.5%, which signals economic trouble. There's one more red flag we need to address: VNQ's payout ratio of 134.85%. They're paying out more than they earn, which sounds catastrophic. But context matters. REITs use funds from operations and adjusted funds from operations as sustainability metrics, rather than net income, because depreciation doesn't reflect actual cash generation. A healthy REIT maintains an FFO payout ratio between 75 and 85%. When FFO multiples exceed 90%, dividend cuts become likely during downturns. The 134% figure is misleading, but the underlying concern is real. Dividend sustainability is fragile. So, when does VNQ actually make sense? If you're in the 24% tax bracket or lower, the after-tax yield advantage remains meaningful. If you have 10+ years and can tolerate minus 25% annual volatility, you might weather the storms. If you genuinely believe interest rates will decline below 3.5% in the next 2 to 3 years, REITs could deliver. And critically, if you're investing through an IRA or 401k, you completely avoid the ordinary income tax problem. Tax-advantaged accounts are where REITs belong. You might also consider sector-specific exposure to data centers, healthcare, or industrial REITs rather than broad VNQ exposure, capturing the winners without the office sector anchor. But VNQ doesn't make sense if you're in the 35 to 37% tax bracket, where after-tax yields collapse below 2%. If you're risk-averse and can't handle 17.72% volatility, stay away. If you believe rates will remain stable or rise, traditional dividend stocks will likely outperform. If you need predictable income, REIT distributions vary significantly year over year. And if your time horizon is under 5 years, you can't absorb potential minus 20% declines. Here's the ultimate truth. REITs are interest rate derivatives disguised as real estate investments. That 4% yield looks attractive until you account for taxes, volatility, interest rate dependency, and sector-specific risks. For high-income investors in taxable accounts, traditional dividend stocks with qualified dividend treatment often deliver superior after-tax returns despite lower headline yields. Before you chase that yield, calculate your actual after-tax income, understand your tax bracket impact, evaluate your rate outlook, and decide if you're truly making a real estate investment or just betting on the Federal Reserve. Don't let a seductive yield number destroy your wealth. Understand what you're actually buying and make the decision that's right for your specific situation. If you found this valuable, smash the like button and subscribe for investment deep dives. Comment below what you want me to investigate next. Share this with someone who needs to see the real numbers. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.